So most of the people alive today and investing today have never seen a stock market react to much higher interest rates. And if you just do some real basic math, you
Right.
assume that the economy is going to do well under Trump. So we get to
Right.
3 or 4% nominal GDP growth. Okay, that's
Mm-hmm.
good news. But you're also going to see inflation at 4 to 6%. And if you add those two numbers together, that's the most basic formula for figuring out what the 10-year yield will be. So if you expect 3.5% growth and 3.5% inflation, that gets you a 7% yield on 10-year. And I'm
Mm.
sorry, Danielle. We're at Porter and Company. We're long 42 different stocks right now. People want to paint me as a perma bear. I've
Yeah.
never not been an investor in the stock market. But my point is, when stocks are at 28 times earnings on the S&P, when they're at all-time record highs, and you now know, ringing a bell, that interest rates are going way higher in the bond market, it is a time to be conservative. And that is the message that I've been saying. You could actually see a 50% correction in
Okay.
stock prices, assuming earnings are flat. Now, earnings aren't going to be flat. So let's say the market multiple corrects from 28 to 14. Nobody is calling for that. Nobody expects it. But there's no question in my mind that that is exactly what will happen over the next 2 years. Now, I don't have a crystal ball. I can't tell you at what date the stock market is going to wake up and recognize there's a big problem in the bond market. But I can tell you it will happen. Investors have a constant choice. You can either buy bonds or you can buy stocks. And you buy stocks when the earnings yield at the stock market is much higher than the coupon rate, than the interest rate in bonds. And so you do that because you of course you want to get paid. And so right now the earnings yield in the stock market is about 3%.
Right.
And the right now the yield on the bond market is 4.5. So I'm just telling you, it's not going to be long before people go, maybe I should buy some of these bonds too. Now, listen, I agree with you. I'm not recommending bonds. I think bonds are a terrible choice right now because yields are going to keep going higher. So please don't misunderstand me. I'm not saying sell stocks and buy bonds. I'm saying that stock prices in real terms are going to have a very difficult decade because the market multiple is going to correct. And the things that are going to do better relative to stocks are going to be things like Bitcoin, things like gold,
Yeah.
things like certain kinds of stocks that really benefit from an inflationary period. I think Hershey. Hershey is one of my very best ways of hedging against an inflationary environment. And if you do a bunch of research like I've done, you'll discover that an ounce of chocolate is a better hedge against inflation than an ounce of gold.
Wait a second, Porter.
It's true. It's
Hold
absolutely
on. Hold on. Stop
it's true
everything.
because it's
Okay,
true
explain
because
this one. Explain it.
no,
Well, because you're saying cocoa as a commodity. Are we talking?
it's true.
What are
It's
you?
true. It's true because in America, Hershey so dominates the
Right.
chocolate confectionery business that you get a whole lot of additional gain relative to brand value and distribution value that you just don't get with gold. Because of course, gold is simply a commodity. Nobody goes out and buys the Coca-Cola gold or the Hershey gold or the Philip Morris gold. So gold doesn't get the advantages of that kind of brand value that will compound with time. And
Because
so
you're saying not everyone knows Barrick or the Newmont.
no, what I'm saying is when you buy an ounce of gold, you have no idea who made it and you don't care.
You don't.
But
Right. Well.
when you buy a cigarette or when you
Right.
buy a Zen or when you buy a soft drink
Right.
or when you buy a piece of chocolate, you care very deeply about who made it. And that gives them pricing power. And that pricing power is on top of the increase to the production costs that occur with inflation. And so investors will actually do better over time, buying something like Hershey when it's trading at 14 times earnings, a fair price, than just buying an ounce of gold.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.